Let's get more on these U.S. bank earnings. We've heard from giant lenders, including JPMorgan, Goldman Sachs, Wells Fargo, and Citi. And we're awaiting Bank of America tomorrow. Our guest says U.S. bank shares have done just fine in recent months, but we're seeing some weakness in some of the names this morning. We're joined by Paul Harris, portfolio manager at Harris Douglas Asset Management. Paul, great to see you. Could you start off with Wells Fargo? In recent years, it's been under a cloud, but investors like the look of the forecasts and the numbers from the company this morning.
Yeah, so I mean, as you mentioned earlier on, I mean, the banks have done sort of well into the quarter, and kind of weakness in the first little bit of it. But I think Wells Fargo, people like the story because one, they've come out of this very difficult time under administration, I would guess, overseeing their company by the government, and so they're free of all those things right now. One of the things is that it's a bank that really is driven by the consumer more than anything else. It doesn't have a big investment bank like JPMorgan or Goldman or any of these other places. They do have an investment banking business, but it's not as large, certainly. So I think that's what they're looking for. I think that they are giving guidance which they can achieve or beat, which is very important in the world we live in the investment world. So I think that's one of the things that's helping Wells Fargo. It was certainly undervalued going into a lot of this stuff, so that made it a little bit cheaper as a relative to the JPMorgans of the world. So I think that's one of the reasons why people like the stock, and I think they're actually meeting a lot of their kind of goals. From the goals they're trying to achieve from the not only on the investment side but also on the banking side.
JPMorgan, though, down, even though there was a pretty substantial beat from them.
Yeah, so I mean, I think, as you mentioned, as the gentleman mentioned before on the show, I think there was a lot of expectations. I think generally people feel that banks are going to do well, especially the investment banking area. That's what JPMorgan did. I will say that they did increase the loan loss reserves, on the consumer side. I think that's one of the things that maybe people are feeling, although that there may be some weakness down the road on the consumer side, given there's a lot of things happening over the next little while, where you may see kind of those tariff increases hurt the consumer, that sort of stuff. So I think that didn't help JPMorgan. But I think, JPMorgan's done incredibly well. It's perceived to have the best management in banking with Jamie Dimon. And so I think that, and their investment bank certainly does well. And I think you've seen this through the whole piece, right? If you look at JPMorgan, you look at Goldman, you look at Citi, the investment banking side did very well throughout the last quarter. There's lots of volatility, which really helps investment banks. There's a freedom, I think, because of the Trump administration to do M&A, a lot more IPOs, a lot more corporate finance going on. So I think all those things really help the investment banks, and their numbers are certainly exploding on that side. And I think that probably will continue into kind of the year end. So the investment banking side is really helping the banks as opposed to hurting them, several quarters ago, where they didn't have this kind of wind at their back with a lot of these other things happening. So I think you've seen a very good thing. I mean, these stocks have done well. They pulled back a little bit. I think they will continue to do well. JPMorgan's probably the most highly rated stock in that city of the money center banks, is the most poorly rated stock in that whole area. And Citi's going through a very large restructuring on an ongoing basis, but you can see the numbers coming through.
Citi stock, I'm not sure if we looked at it there, it was flat last time I looked, so not a wildly or basically unchanged. Goldman Sachs, there we have it. Yeah, it's up about 0.25%. Anything jump out for you with the Goldman Sachs numbers, Paul?
No, I mean, Goldman is although they're a bank and they have, they've never done well in retail, and that's really not their strong point. And in fact, they've closed some of that down. Really what they are is a big investment bank. And you can see from their numbers that they continue to produce very strongly on the investment banking side. And I think they will continue to do that on the asset management side as well. I think the other thing that's very important about U.S. banking, which doesn't affect kind of the money center banks like we've seen, but there's a sense that you can have more M&A on the regional banking side. You've already seen a couple of deals. I think that will continue in U.S. banking over the next several years because the Trump administration is more agreeable to M&A on that side. So you've seen Fifth Third and Comerica do a deal. You've seen a couple of other deals. I think banking is a scale business. You need to get bigger, and I think that's going to happen. These money center banks really can't do acquisitions anymore. They're too much on the. They have too much. They're way too high on the deposit side, et cetera. They maybe do smaller ones, but very unlikely. And I think so. You have an administration that's very happy to do that. So I think you're going to see more and more banking deals happening, and just the general environment with the IPO market and the M&A market outside of the banking business will continue to be, I think, very fruitful to these large investment banks.
Paul, I've been going on about this morning. The viewers may be sick of it, but I do think it's a fascinating story. Politico, the US website today, says that what's happening in the US credit markets right now is sending a shiver down the spine of those who remember 2008. And that in particular is worries about what's happening in the world of private credit and after the collapse of the US auto loan dealer Tricolor and then the parts supplier First Brands. I think some people are wondering, could that be a canary for the entire financial services industry?
Well, certainly, I think that there's a big issue with all this stuff. I think private credits, especially, has been very difficult for things. But I would really think of when you look at private credit, I would look at more kind of the Apollo and all these other guys that are really have private credit funds, which may cause a lot of problems, right? As opposed to banks, which are involved in it, don't get me wrong. But I think banks have a better understanding of their credit book than years ago, and I think that will be helpful to them, and they're much more diversified. Whereas if you're running a fund that just does private credit, and few of these things go poorly, you can see what happens. It happened in Canada with the real estate guys. They'll shut down redemptions. They'll do all these other things with it, right? So I think that's where you have to worry about private credit in those areas. I think the banking industry, of course, they may get hurt with it, but they were probably reserved in a very different way to deal with these issues.
Paul, thank you very much indeed for joining us.
My pleasure.
Paul Harris, Portfolio Manager at Harris Douglas Asset Management.